Very often we do see that the CEOs and owners do focus on margin, which is obviously an important metric to follow. But what we will see in the example in the video today is that if you only focus on margins, you actually lose what you are there to be doing, whether you're an owner or a CEO, which is to be the guardian of capital. And the key metric there is return on investment. When you do not focus on cash and the speed of converting cash, you lose sight of return on investment. And that actually the leading indicator for return on investment is actually cash and how fast cash flow can be returned to the owners. So here is a customer that has two options, two types of customers to sell to. And let's assume that they buy inventory, they're a trading company, and they buy inventory for 500 of whatever currency. And let's assume, let's make two key assumptions of one, that they have no SG&A. So they are purely a trading company. They have no other costs than what they buy for, which is the inventory, and what they sell. That's just to make it a bit simple for our example. And then they have no surplus cash, meaning that the 500 that they've just invested into inventory is all they have. So they cannot reinvest or invest in anything else until they actually sell this inventory, hopefully for a profit, and can then reinvest this. So now let's assume that they have two customers. They have customer A and customer B with slightly different characteristics. For starters, the sales price for customer A is 800, so with quite a good profit, and for customer B it's gonna sell for a little bit cheaper, for 650. Another difference is when it comes to payment terms. The first customer A is asking for 90 days credit. So once you sell for 800, it will take you 90 days or 3 months, in other words, to get the cash to your bank account to be paid. And that is assuming that they pay on time. Whereas for customer B, although we're selling it for a cheaper price, they are willing to pay us in 30 days. So if we then look at the margins of each transaction, so this would be per deal, it would mean that we are selling it for 800 and we bought it for 500. So we have a profit margin of, we can call this profit to be more clear. We have a profit margin of, or a profit of 30. Whereas in the case of customer B, we have a profit of 150. Okay. And in percentage terms, so the profit margin percentage would then be obviously 300 divided by 800 would be, in rounded terms, 38%, whereas in the case of customer B is 23%. So if we just stop here, in many scenarios and a lot of live cases, this is actually a live case with a little bit of changed numbers. Management and the people in the organization would at this point favor customer A over customer B. Yes, it's true that we get paid 90 days after the sale, whereas in the second case we get paid after 30 days, but we're making a lot more money. You know, a 38% versus 23% is an easy sell. So I'd say this is very common that customer A would be favored, and at this point it does actually make sense. However, if we move to the next important item, which is, let's say, total net income for the 90-day period. So for the 90 days, if we assume that the 90 days is our quarter, and this is all we can do because we're tied on cash, so we only have the initial 500 of cash. So once we buy that inventory, we really need to wait until we're paid before we can reinvest it. So in the case of customer A, we really will not be able to do much more business than sell this one unit or this inventory of 500 and wait for the payment. So our total net income for the 90 days period is the same as the one transaction that we did. However, in the case of customer B, because we're getting paid in 30 days, we're actually able to take the same money and reinvest it 3 times. And let's, for a very simplistic scenario, just assume that they are just investing back the same inventory. So I'm collecting the profits, but after 30 days, I get 650 into my bank account. I invest 500 of that in new inventory, sell it for 650 again. After now 60 days, in the second cycle, I'm getting back another 650 and I keep the 150 profit. So now I have a total profit of 300, and I go again and buy 500 of inventory and sell it a third time. So in 90 days that we're looking at here, I have 3 turns of my inventory that I can account for. So what does that mean? That means that I get a profit of 153 times, which is a profit of 450. Now, where I wanted to get to is the most critical metric for an owner or a CEO is to get return on investment. Ultimately, an owner is looking to invest money and get a return for that money. And if we have a CEO in place, they are, in other words, an agent of the owner or a guardian of the capital on behalf of the owners. So their key metric should also be return on investment. So if we look at return on investment for the 2 customers or the 2 scenarios, in the first case, I'm getting a return of 300 for an investment of 500, and that is, in percentage terms, 60%, which is not bad. However, obviously, since I'm getting more in total terms from customer B, my return on investment is much higher, 90%. So the real point of this example, which is very close to a real example that we encountered very recently, where customer A would have been preferred until we actually look at return on investment or total net income for the period. Customer B is really a better option, even though it means that we're making less margins. An important factor is the payment terms and cash being central to the decision of why we go with the second option. Customer B has a better cash profile, and in most cases, and this is an example, it's a leading indicator if we can get a better cash cycle to how well we also get return on investments.